Hello fellow investors and welcome to this month's portfolio update. February was another steady month for my P2P portfolio. Most of my capital has already been deployed since the beginning of the year, so this month gives a good picture of how the portfolio performs when it's running close to fully invested. If you are one of the eagle-eyed viewers who spotted the dragon-themed question mark, you probably know that something new is coming. In February, I added a completely new platform to the portfolio that comes with a very different investment niche and some unusually high returns. In this update, I'll show you how much income the portfolio generated in February, which platforms delivered the strongest results, and whether this new platform actually improves the overall portfolio performance. As every month, let's start with Income Marketplace. My investment on the platform currently stands at €7,799 and during February it generated over €61 in interest. This gives an annualized ROI of about 9.5%. Overall, the platform continues to run smoothly, repayments are coming in as expected, and most of the funds remain deployed without large amounts of idle cash. Compared to last month, income came in slightly lower, but this mainly reflects normal fluctuations in loan repayment and reinvestment timing. For me, Income Marketplace remains a stable, mid-yield performer and continues to play an important role in the portfolio. My Lande position is slowly being liquidated. It currently sits at over €1,300 and in February this investment generated €4 in interest. Lande recently published the platform performance report for January 2026. In short, the report highlights steady platform growth, expanding investor acquisition channels, and a focus on scaling the business, while continuing to fund agricultural loans across its markets. Unfortunately, the slow recovery casts a long shadow over my portfolio, as well as the stubborn default numbers. For me, Lande is just too slow and cumbersome for a modern P2P portfolio. Moving on to Fintown, my current investment here stands at over €1,000 and during February generated €58 in interest, which translates to a ROI of about 8.6%. Return remains stable and predictable, which is typical for the real estate-backed loans on the platform. There were no major developments this month and repayments continue to arrive as expected. Fintown may not offer the highest yields, but it continues to provide consistent and relatively stable income. My remaining position on EstateGuru currently stands at €2,467. At this stage, the exact return on investment doesn't really matter anymore. What really matters is how EstateGuru is recovering the outstanding German loans. A good example of what investors can expect is the recently recovered bridge loan 8,529. In my case, out of the €51 I originally invested, more than €45 were written off, meaning that by the end of February 2026, I recovered only around €6 from an investment that was made back in 2021. What makes this case particularly notable is that the loan was supposedly secured with a first-rank mortgage. The collateral was valued at over €5 million, while the total mortgage attached to the project was around €2.7 million. And yet, despite these seemingly strong numbers on paper, the actual recovery for investors ended up being extremely small. This is unfortunately a very real part of investing, and something investors always need to keep in mind, even when the loans appear well secured. So, always keep in mind to invest only what you can afford to lose and do your own due diligence. On the opposing side of the spectrum, we have Inrento, where my portfolio stands at over €12,000 and in February generated €87 in interest, which gives an ROI of about 8.4%. The platform continues to deliver very reliable performance. There have been no delays or defaults, which is the biggest advantage of Inrento. The only limitation is reinvesting, since new projects often sell out quickly. But overall, Inrento remains a very stable real estate platform in my portfolio. The platform recently announced another important milestone. In February 2026, Inrento crossed 80 million in total investments, following a very strong year in 2025, where the portfolio almost doubled in size. Investor profits also grew significantly, increasing from 3.1 million to 7.3 million, while the value of realized investments rose more than fourfold to over 24 million. At the same time, the number of active investors increased by around 30%. One of the most notable aspects of the platform's performance is that despite this rapid growth, Inrento still reports zero defaulted projects, which the company attributes to conservative financing structures and strict project selection. Overall, the platform continues to expand across multiple European real estate markets while maintaining a strong track record of completed projects and investor payouts. Now, let's move on to Viainvest, the largest position in my portfolio and at the same time one of the oldest ones. The portfolio currently stands at over 18,000 euros and in February generated over 164 euros in interest, which results in an ROI of around 10.9%. Once again, Viainvest behaved exactly like an income engine. Repayments arrived consistently throughout the month and there were no operational issues affecting the platform. Because of this stability, Viainvest continues to be one of the core income generators in the portfolio. The platform continued to show stable activity in February. During the month, around 11 million in loans were funded and investors received close to 400,000 in interest payments. Interest rates on the platform remained up to 13%, keeping Viainvest among the higher yielding consumer loan platforms in the portfolio. Overall, the platform maintained steady funding volumes and continued to generate consistent interest payouts to investors. My investment on PeerBerry stands at 16,115 euros and during February it yielded 121 euros in interest, giving an ROI of roughly 9%. PeerBerry continues to deliver very consistent monthly cash flow. The secondary market, which was introduced earlier this year, seems to work well from a technical perspective. However, for a buy and hold investor like myself who already experiences some cash drag, it doesn't add much value. Most of the listings on the secondary market are loans from loan originators without a group guarantee, and they tend to be longer-term loans with relatively low interest rates. Overall, PeerBerry remains one of the most dependable platforms in the portfolio. On PeerBerry, the platform continued to grow steadily in February. The total outstanding portfolio exceeded 118 million, reflecting continued investor demand and strong lending activity from the Aventus Group loan originators. During the month, investors were paid over 1 million in interest, while the platform maintained its historically strong repayment performance. Overall, PeerBerry continues to show stable growth and remains one of the larger consumer loan platforms in my portfolio. My current investment on Esketit stands at over 16,000 euros and in February generated over 150 euros in interest, which corresponds to a ROI of about 11.1%. The platform continues to deliver strong income, however, my strategy has changed. Because of previous operational concerns with the movement to Croatia, I'm still gradually reducing the size of this position rather than increasing it. So while Esketit remains a strong performer in terms of income, risk management still plays an important role here. Esketit shared a couple of updates recently. A new lending company, Jet Finance from Kazakhstan, joined the platform, expanding the available loan supply with vehicle-backed loans from the Central Asian market. In addition, Esketit launched a limited-time 2% referral bonus campaign, doubling the usual referral reward for investors who invite new users to the platform. My investment on Astara Estate stands at 8,584 euros and in February generated 98 euros in interest, which translates to a strong ROI of around 13.8%. This places Astara Estate among the highest yielding platforms in the portfolio. The platform continues to provide regular updates on project developments, which is helpful for monitoring the progress of the underlying real estate investments. Over the past half a year, they also managed to sign several lease agreements that will secure additional cash flow for the company and strengthening their financials. Despite the strong returns, this remains a higher risk allocation, so I continue to limit the overall exposure and withdraw my funds monthly. Moving on to another high-risk position. My Ventus Energy investment stands at over 4,200 euros and generated 52 euros in interest, giving an ROI of about 14.8%. These returns are obviously very attractive, however, we must not forget that this is a speculative investment. Because of that, I intentionally keep this position relatively small, monitor it closely, and withdraw the interests monthly. My investment on Afranga currently stands at €9,699 and in February generated €99.91 in interest, resulting in an ROI of about 12.4%. This platform has been delivering very stable performance. One of my goals with Afranga has been to maintain roughly €100 per month of income, and February once again came very close to that target. Overall, Afranga continues to be a reliable income generator in the portfolio. Afranga also introduced a new investment product called Save Smart. It's a fixed term option where investors can choose between 3, 6 or 12-month terms, receive monthly interest payments and get their principal repaid at maturity. The idea is to provide a simpler, more predictable investment option for investors who prefer a hands-off approach rather than selecting individual loans. At launch, the product is offered through the loan originator Stick Credit, a solid choice, and investments are locked until maturity. Moving on to Nectaro, my current investment here stands at a little bit over €10,000 and in February generated €74 in interest, which corresponds to a ROI of about 8.8%. Returns remain stable and predictable, mainly driven by credit prime lending operations. There were no major platform developments during the month and repayments continued to arrive as expected. Nectaro therefore continues to serve as a solid and stable platform in the portfolio. Now before we finish, I would like to introduce the new platform in the portfolio, Triple Dragon. My current investment here stands at €4,000 and in February this generated €134 in interest and bonus payment, which results in an ROI of about 40.3%. But since this is a new platform in the portfolio, let me briefly explain why I decided to add it. Triple Dragon is a UK-based financing company founded in 2016 that specializes in funding video game and mobile app developers. The loans are typically backed up by receivables from major platforms like Apple, Google or Amazon, where the games are sold. The lender is also not completely new to the P2P ecosystem. Triple Dragon has previously issued loans through Debitum platform, which provides at least some track record in the crowdfunding space. From a due diligence perspective, there were a few reasons why I found this interesting. First, the company has almost a decade of operating history. Second, many loans are backed by revenue streams from game sales, which gives the investment a clearer underlying cash flow. And third, the platform offers very high yields with relatively short loan durations. Of course, this is still a high-risk investment, which is why I started with a smaller position of €4,000. For now, I see Triple Dragon as a high-yield satellite position that helps boost the overall portfolio return without taking too much risk. And because of the bonus campaign, Triple Dragon has already made a noticeable contribution to this month's income through the assigned bonuses and some interest. But of course, the real question is, how did the entire portfolio perform in February? So let's zoom out and take a look at the overall results this month. In February 2026, the portfolio generated a total of €1,113 in income. The total portfolio value now stands at over €119,000, which corresponds to an average return of about 11.2%. Once again, the majority of the income came from the core platforms such as Viainvest, PeerBerry, Afranga, Nectaro, and Inrento. Higher yield platforms like Estate, Ventus Energy, and Triple Dragon helped boost overall returns but remain smaller allocations due to their high risk profiles. Overall, February was another stable income month and the portfolio continues to perform in line with expectations. Thank you for watching and have a nice day.